Ever heard of the old age security clawback? Well, it's a thing. And the claws are real. And it doesn't just happen to rich people. It can, and it does, happen to all sorts of people. And it doesn't matter how nice or good looking you are, you can lose some or all of your old age security benefits. But don't worry, I'm going to show you how it works in plain English, and I'm going to show you a bunch of different things you can do to try to minimize or avoid the whole darn mess. My name is Reese. I'm the founder of Well Built Wealth, but you don't really care about that. You just want to know how to avoid the OAS clawback, and that's fair. But before we get into that, I do want to make it clear that not all strategies are good for everyone. Something that might be a genius idea for Harry might only work okay for Larry, but be entirely stupid for Jerry. And we also don't want to lose the forest for the trees. Yes, you want to avoid as much of the OAS clawback as possible, for sure. But make sure you have a custom, intelligent game plan that takes your whole situation into account and not just the clawback. Otherwise, you can end up hurting yourself in other ways and just end up further behind. Now, it should also be mentioned that most people don't end up having their OAS clawed back, or at least not on a regular basis. But it can definitely still happen in certain years if you have a spike in taxable income and either don't have a game plan for how to deal with it, or you simply can't. More on that later. Now, it should also be said right out of the gates that some people simply make a ton of money in retirement, and no matter what they do, OAS clawback is coming for them. Now, that doesn't mean that we shouldn't do whatever we can in order to minimize it, but sometimes there is simply no way around it. But that's enough of the preamble. Now we're going to jump into the key applicable details of OAS and how the clawback works. And as always, if you're a wizard and you already know this stuff, then feel free to skip ahead. Basically, OAS is a government-sponsored pension plan that people get simply for living in Canada. The benefit starts as early as age 65, and the amount you get is indexed to grow over time with the cost of living, which is nice. But you should also know that all the money you get from it is fully taxable, which is not so nice. Now, how much you get is based primarily on how long you've lived in Canada after the age of 18. If you've lived here for 40 years, you'll be eligible to get the full pension. If you've lived here less than that, then your benefit will be reduced. Now, I have plenty of videos that go into all these details, including how to figure out how much you'll be eligible for, so I'm not going to bog us down with all of that here. But if you're wanting a deeper dive into all things OAS, I recommend you check them out. Another key determining factor in how much you'll get is when you start taking it. As mentioned before, the earliest you can start is age 65, but you can delay it to as late as age 70 if that makes sense for you. And for each month you delay taking it, you'll get a permanent increase of 0.6%. Obviously, 0.6% doesn't sound like much, but if you wait a full year, that ends up being a permanent increase of 7.2%. And if you wait the full 5 years, all the way to age 70, well, then you end up with a permanent increase of 36%. Now, to put some skin on this, the maximum amount you can get from OAS right now, as of early 2026, if you're 65, is $742.31 a month. But if you delay taking it by 1 year and start when you're 66, your benefit would increase by 7.2%, or $53.45 a month. Again, that's not earth-shattering. But if you wait until you're 70, the increase is 36%, or $267.23 a month. So now you're looking at a total of $1,009 a month for the rest of your life. And that's not even counting all of the inflation indexing you'd get along the way. Anyway, this isn't meant to convince you that delaying OAS is a good plan for you. I just want to make sure that you understand how it works as it plays into some of the strategies we're going to look at shortly. But before we get into that, let's switch gears and dive into the clawback and how that works. Okay, basically, the government doesn't want this benefit to go to those that it thinks make too much money. So once you hit a certain income threshold, the government will start to claw back your benefit. Now, technically, they call it a recovery tax, but no one in the real world calls it that because that sounds boring, while calling it a clawback sounds a little bit like you're getting mauled, which is kind of how people feel when they lose their OAS after having spent their entire lives paying the Canadian government an obscene amount of tax. Anyway, let's get into the numbers. For the 2025 tax year, the magic number is roughly 93 grand. If your net taxable income is less than that, no clawback, you're safe. But for every dollar you earn above that $93,000 threshold, the government takes back 15 cents of your OAS benefit. And this continues until your income hits about 152 grand, at which point your entire OAS is gone. Nada for you. Now, if you want to find out roughly how much clawback you may be looking at, it's super easy to do. You just add up your taxable income minus the lower threshold amount, and then times that by 15%, and that's your clawback. For instance, if your income is going to be 100 grand, just minus the clawback threshold of 93,454, and you'll see that you're $6,546 into clawback territory. Now multiply that by 15%, and that's the amount you can expect to have clawed back next year, $981.90. Now that's the annual amount. So if you want to know how much your OAS payments will be reduced each month, then you're going to need to divide that by 12, which in this case is a reduction of $81.83 each month. And of course, the higher your income is, the more that you will lose to clawback until you pass that upper threshold and simply lose it all. Now, you might be noticing that there are different and higher upper thresholds for those age 75 and older. And that's because you get an automatic 10% increase to your OAS benefits when you turn 75. And that can be a nice little bump. And happily, it also increases your thresholds as well. Fun fact. Now you might be thinking, that's cool, Reese. Those are some really pretty numbers and some very fancy tables, but I am never going to do all that math. No worries, I got you. You can also use an online calculator like this one to help you figure it all out. I'll link it below. Anyway, back to it. Because the government doesn't know how much money you made in the previous year until well into the spring after you file your taxes, the OAS recovery tax cycle runs from July to the end of June. Simply put, each July, everyone's clawback amounts, if any, are reset based on how much they made last year. And this is very important to remember when you're first retiring because it's very easy to run into some grief here. For instance, if you're 65, you're retiring early in the year and you're thinking, sweet, I'm done working, got a lower retirement income now, time to turn on my OAS. And that might work out well for you. But just remember that they are looking at your last year's taxable income. And if you were still working last year, making solid income, then you could end up in clawback territory right out of the gates by accident. And needless to say, that could be a serious party pooper, especially if you were counting on that income. Now, you may end up getting some or all of the recovery taxes back later after you file this year's taxes because your income is indeed going to be lower. But for many people, the best strategy may just be to simply delay taking their OAS until that first year of retirement is passed. That may help you avoid the clawback and get an increased OAS benefit for the rest of your life. 2 birds, 1 stone. But that's not the only scenario this delaying your OAS strategy makes sense in. Many people continue to work past 65. And if they're making a lot of money and they're taking their income up over those clawback thresholds, then they're going to lose some or all of their OAS benefits anyway. So they're usually way better off simply delaying so that they at least end up with an increased benefit out of it when they eventually do retire. Now, I've actually seen people make this mistake quite a few times. So then not only do they lose their OAS benefit for those years, but then they don't get the increase for the rest of their life either. And it's not because they're stupid. In fact, some of these people are incredibly smart and they're just killing it at the jobs that they do have. but they're paying attention to that stuff and they're not really paying attention to this stuff. And so it's really easy for this kind of thing to slip through the cracks. You see, for many people, if they're filing their taxes properly and there aren't any other outstanding issues with the government, then OAS payments will simply start automatically when they turn 65. You actually have to tell Service Canada if you want to delay. If you don't, then it might very well just start and you might not even notice. Needless to say, this can end up being a really expensive mistake. But don't panic. If you've just made this mistake, there is a grace period. If you submit your request to cancel the payments within 6 months and pay the payments back, you can make it like this never even happened. Strategy number 2, use your RRSP or a spousal RRSP to offset a spike in income. There can be circumstances where you all of a sudden end up with a bunch of extra taxable income in a year. Usually things like inheritances or gifts or life insurance payouts wouldn't count as taxable income, so you usually find there. But a very common example of a sudden taxable event is a capital gain. If you have a secondary property or a rental or a large non-registered equity position and you sell it for a gain, that is called a capital gain. And in Canada, half of your capital gain is taxable in the year you have the gain. So if you bought a cottage for 300 grand and you sell it for 700 grand years later, you'll have a $400,000 capital gain. And since half of that gain is taxable, you'll be adding $200,000 to your income. And if you recall, that will throw you well past the top end of the OAS clawback range, which would lead to you losing all of your OAS for a good year or so. So if you have a decent amount of RRSP room and you aren't older than 71, you can make a big contribution to your RRSP and get a nice, juicy tax deduction to offset as much of that taxable capital gain as makes sense in your particular situation. Now, it's true, you'll have to pay tax on those funds later when you pull them out of the RRSP or RIF, but you'll likely be doing that over time and at lower tax rates, and you'll hopefully be saving your OAS from a clawback in the meantime. Of course, you can do this year to year on a smaller scale as well. If you find yourself creeping up past that lower OAS threshold, then small RSP contributions here and there can be a very easy way to bring that taxable income back down under the line. But don't forget, you only have until the end of the year that you turn 71 to make RRSP contributions, so keep that in mind. That said, if you have the RRSP room and your spouse is 71 or younger, then you can still contribute to a spousal RRSP, which can be a real handy workaround. Strategy number 3, the good old RRSP meltdown. First things first, there is quite a bit to know about the RRSP meltdown and how to apply it properly to your situation, if you should apply it at all. But I have a detailed video on that exact topic, and it's one of my most popular videos, so we're not going to go crazy with the details here. But here's the basics as it applies to the OAS clawback. See, a lot of Canadians end up saving quite a bit of money into their RRSPs, and they tend to leave them alone until they're forced to flip them into a RIF and start taking money out in the year they turn 72. And there's some logic to that. All the money that's in an RSP grows tax-free as long as it's in there. So leaving it alone for as long as possible really allows it to compound and grow on itself. And that's delicious. But there can also be a wrench in the plan: taxes. See, once you flip your RRSP into a RIF, you have to pull out the minimum amount each year. No choice. And as you can see on the chart here, that percentage increases every year as you age. And so for some, their RIF minimum withdrawals can get absolutely massive in their 70s and their 80s, especially if they have large accounts. And since those minimum withdrawals get added to your taxable income, whether you want them to or not, you can find yourself deep in the clawback woods without a flashlight. Anyway, an RRSP meltdown basically flips the script. Instead of letting your RRSP balloon and explode later, you draw from it strategically in your 60s or earlier when your taxable income is lower, assuming you're retired, of course. This spreads out your taxable income more evenly across retirement rather than having less taxes earlier but a huge spike later. Again, for some people, their RSPs are so big there's no point. They might as well just let them run. But for many people, this strategy can not only help them avoid the dreaded clawback, but it can also lower their total lifetime tax bill and reduce the final tax hit on their estate. And for some, they can really supercharge this whole strategy by delaying their CPP as well. But that's a whole nother animal. And I'll refer you back to my meltdown video if you want to see that in action. I've dropped the link below. Strategy number 4, milking your tax-free savings account. Well, there it is, right in the name, tax-free. But it's not just the growth that's tax-free. It's also the withdrawals. So you can pull out as much as you like whenever you like from your TFSA without having it push you up into clawback territory. Now, you don't want to drain your TFSA willy-nilly, obviously. You want your TFSA to last. But if your taxable income's sitting at 93 grand and you need an extra 10 grand for some hair implants, you probably shouldn't pull it from your RRSP, as that'll trigger the clawback. But if you pull it from your TFSA, no problemo. Strategy number 5, pension income splitting. If you have a spouse, this can be one of the most powerful and straightforward ways to reduce or totally avoid the OAS clawback. A lot of couples have one spouse who's earned more over the years and may have ended up with a larger RRSP or RIF or defined benefit pension, etc. And so this one spouse may be crossing over into clawback territory while the other spouse isn't even close. But Canadian tax rules let you split up to 50% of eligible pension income, which most commonly includes RIF or LIF withdrawals once you hit age 65, or income from a defined benefit pension plan. Basically, it allows you to shift income on paper from the higher income spouse to the lower income spouse. Not only can that help bring the higher income spouse below the clawback line, but it can also end up reducing the couple's total combined tax bill as well. Absolute hardcore no-brainer. Strategy number 6, sharing CPP or QPP with your spouse. This strategy is super similar to the last one, but usually doesn't pack nearly as much punch. If you and your spouse are both at least age 60, you can elect to share your Canada pension plan or Quebec pension plan benefits. And again, this might make sense where one spouse is receiving more CPP or QPP and is in a higher tax bracket than the other spouse. By choosing to share the pension, which you can do by applying with Service Canada, a portion of the pension can be received by the lower income spouse and taxed in their hands. Again, not only can this lead to tax savings in general for the couple, but it can also effectively lower the taxable income of the higher income spouse, which in turn could help reduce or eliminate any OAS clawback they might be facing. Strategy number 7, shifting what you own in your non-registered accounts. If you've already maxed out your TFSA and you've stuck as much as you're going to into an RRSP, then it's pretty normal to start stacking chips inside of a non-registered account as well. And that's great. Except that non-registered accounts, which are commonly called taxable accounts, are, well, fully taxable. And what that means in plain English is that you have to pay tax on all the interest, dividends, and capital gains you make in these accounts, which, as you can probably guess by now, can push you up into clawback territory. So you want to be strategic about what you have going on in these accounts. Now, I don't want to get too deep in the weeds with all of this, but it's important to understand that interest, dividends, and capital gains are all taxed differently. And how much of each you have will totally end up impacting how much taxable income you end up with. But the main one I want to hone in on today is dividends, because there's a bit of weirdness that goes on with dividends, or at least with Canadian eligible dividends. Lots of Canadians love to buy stock in Canadian companies that pay dividends because it enables them to claim the dividend tax credit, which is super appealing from a tax perspective. However, there's a bizarre formula that goes into calculating the tax credit that actually grosses up the dividends by 38% so that the amount included in your taxable income is actually 138% of the actual dividend received. So this actually artificially inflates what is counted as your taxable income, which of course is pretty lame if you're knocking on the clawback door. So if this is happening to you, you may want to consider shifting some of your investments to those that only generate capital gains. Because as you may recall, only 50% of a capital gain is included in your taxable income, which of course is quite a bit lower than 138%. That said, there's always way more to consider with your investments than just taxes and OAS clawback. Like I said earlier, you don't want to lose the forest for the trees. So make sure you make these kinds of decisions carefully and definitely seek wise advice if this isn't a neighborhood you feel comfortable roaming around in. Strategy number 8, return of capital distributions. Now, since we're on the topic of non-registered accounts, it is worth mentioning that there are some mutual fund products out there that allow you to take return of capital distributions. And this can help you control some of your taxable income since return of capital is tax-free. Basically, with this setup, you're just taking the original amount of your non-registered investment back over time as an income stream. And you're pushing off all of the capital gains until a later date, usually after you've drawn down all of your original capital. Of course, once you've liquidated all your original capital, you're just left with pure taxable capital gains. So the party really only lasts so long. And of course, these mutual funds can often come with notable fees, and they can still generate taxable dividends and interests along the way. So you have to weigh in all of that as well. But this can be a decent strategy for some who have higher taxable incomes now but are expecting an income drop later. And that brings us to the last strategy we're going to touch on today. Strategy number 9, tapping into your home. Yep, I am deeply aware that many people heading into retirement hate the idea of borrowing against the value of their home about as much as they hate the OAS clawback. And I'm with them. We almost always advise against it. It just feels wrong and hurts the soul to spend all those years paying down a mortgage, just turn around and start borrowing from it again. But the truth is, for some people, sometimes it can make sense. You see, any money you receive from most types of loans is tax-free. And while almost any old loan will work, using your home as collateral tends to get the lowest interest rates. Now, there's different ways to do this, like home equity lines of credits, which will usually have the lowest interest rates, or a reverse mortgage, which some people like because you don't have to make loan payments while you still live in the home. But the point is, tapping into the equity in your home can act a lot like a TFSA. It can give you access to money when you need it without having it push up your taxable income, throwing you up into clawback turf. However, unlike a TFSA, you now have debt, and you have interest stacking up on that debt. And that, of course, is no bueno. Anyway, as I'm sure you can imagine, this isn't the entire list of shenanigans that you can pull in order to minimize or avoid the OAS clawback, but it definitely covers some heavy hitters.